if you have US assets, right, that are unhedged, if the Australian dollar loses value, right, your US assets are now worth more in Australian dollars. So actually being unhedged acts as a bit of a buffer for when markets fall, equity markets fall. Now, the flip side of that is when equity markets rise, you typically will erode a little bit of that value of that rise. But we tend to prefer the profile of be a little bit more protected on the way down than and give that up on the way up.
We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke Britton Financial Partners.
All right, welcome to another quarterly market update. JT from InvestSense, and again, everyone's sort of I feel like people are more invested than ever in the market and the news cycle. So it's always a good time to jump on and hear what's happening in the US and how we'll follow. So welcome back again, mate.
Thank you. Thanks, Ben, for having me once more.
It's we do our normal catch up with the team last week, and then sort of jot down some key points and numbers and stats and things that we think are relevant for everyone out there. So I suppose let's just do our normal thing and talk about what's happening over in the US, and again the recent movements that you think are of relevance to us.
Yeah, sure. So look, as you said, the US continues to dominate the headline, and probably for good reason. It's not just because Trump is an entertaining person to have in that seat. It's also because he continues to be the by far the largest economy in the world, and really the one that set the trend for economy and markets, and hence why it is reasonable that we focus on it. I will say in passing something that we haven't discussed at our catch up last week because it hadn't happened yet. Obviously, this particular week, as we speak, is dominated by the Israel attack on Iran's nuclear facilities. At this stage, it doesn't seem to be having a massive market impact, and we didn't necessarily expect it to have one, right? So it's one of the things that we have been thinking about for quite some time. But what are the geopolitical risks around? And while we identified a possible escalation of the war between Israel and Iran as a possible outcome for 2005 to 25, and to be honest, like a few years prior as well, we thought that it wouldn't have a major impact on markets, and so far it hasn't. And that's primarily because Iran has become a relatively small producer of oil relative to what's available in the US, in Russia, in Saudi Arabia, etc. It is only if they try to close the Strait of Hormuz, which is where I think about 40% of the world's oil production has to pass through, that it become more problematic, and there's no sign that it's happening or that they would attempt to do that. So just thought I would mention that and put that aside a little bit so we can refocus on the US. So since we last had one of these catch-ups, there's been quite a lot. So specifically Liberation Day, the Trump administration announcing a whole bunch of tariffs on and quite aggressive ones on most nations in the world, and which caused quite a lot of uncertainty and volatility within markets. And then about a month later, kind of a walk back of all of that, saying, well, we're putting everything on 90-day pause, and we're trying to negotiate with each country separately. Now, the markets have taken the second news very positively and have recovered. And over the last few weeks, have really recovered back to where we were prior to Liberation Day, and actually even higher in some instances. When we start tracking, and that's what we were talking about at our update, when we look at the economic data, the difficulty here is that by its very nature, it takes quite some time to collect economic data. So there's a lag between what we see today, which only really represents what happened over the first quarter of the year, January, February, and March, which today seems completely outdated because the news moves so fast. But for what we can see in the Q1 and beginning of data in the second quarter, is that everything seems to point to a little bit of a slowdown and maybe a little bit more accentuated over those weeks where the tariffs were in the headlines, but definitely a recovery and a kind of a back to normal since then. So that is the positive. We're seeing that in markets, and we're seeing that so far in the economy.
Is the risk we run there where we feel like everything is fixed and cured and we're back onwards and upwards? Is that the sort of bit of a false dawn here?
Absolutely, and that I would say is twofold. I mean, there's several layers of risk in your statement. One is, as I mentioned, the pause in tariff is only a 90-day pause. It's not everything is solved. So there's a fairly small likelihood, but still out there that the tariffs come back in the way they came out in the first place, and obviously that would be quite detrimental. There's a second layer of risk, which is it's a bit like the image of the toothpaste. Where once the toothpaste is out of the tube, it's very hard to put it back in, right? So in that sense, has there been a break in consumer confidence? Too much volatility, too much uncertainty, and just people reining in their spending, consumers as well as corporations saying in that uncertain environment, I can't spend enough, I can't invest, and I got to focus on my savings. So I have to say that's something we're worried about, but we're not seeing any sign of just yet. The third, and probably we think the most serious one, is that the tariff issue is actually hiding something else. And that's something else which we talked extensively about is the deficit of the US government that still needs to be funded. So I'm going to pull in a few different things here. One hope was that with Doge and Elon Musk and the efforts to cut spending plus the extra revenue that the US government will get from tariffs, a lot of that deficit would be solved. It now seems that both of the things are going in reverse. Efforts with Doge and specifically the exit of Elon Musk seems to be on the back foot. The tariffs are probably going to bring some revenue, but not as much as expected. And therefore, you're still left with a hole to fill. And the risk, as we see it, is in order to fund the deficit, the US government is going to have to issue more bonds, right? Raise debt. And investors everywhere are going to be looking at it a little bit suspiciously and say, well, you're up to above 120% of debt to GDP, and you don't seem to be on a sustainable path to a budget surplus. So how much more money are you going to need? And I want to be compensated more for that risk of buying US government debt. Not that I think it's going to go bankrupt, but just need to be compensated a little bit more. And that essentially means the borrowing cost in markets, in the economy is going up. And that's quite a dangerous factor because it usually causes an economic slowdown if those costs go up enough.
So essentially they're saying that they need more money. They need to then obviously take on more debt. And as they take on more debt, that costs them more to do so, which is sort of creating more of a problem that they sort of started out trying to fix, which is always obviously the risk when you try and fix a problem. Sometimes you end up making a slightly bigger one. And I think that obviously that debt to GDP ratio starts to come into the, it's sort of an eye-catching number at 124% at the moment. I don't think we like using the term unprecedented, but I don't think it is amongst other economies. And you had mentioned that you can share the numbers around Japan as an example. And again, I know that every economy is different, and Japan has some quirks about it too. Where do they sit in relation to that?
Yeah, so Japan is currently, I've checked just before this talk, so I know exactly, according to Google, at 216% debt to GDP, so quite significantly higher than where the US at. But actually, even more importantly, is their debt to GDP has actually come down from around 250%. And if you'd asked anybody 20 years ago, can any country in the world get to 250% debt to GDP without essentially imploding? Everybody would have said no, and yet Japan has just done it, right? So, in one sense, we talk about how unsustainable the US situation is. But on the other hand, Japan has done that and worse. And so, which puts us in a quite difficult situation because, yes, it does look unsustainable, but how long can the unsustainable be sustained, right? It could be a problem in a few months. It could be a problem in a few years. It could be a problem, honestly, in a few decades. It's very hard to tell. But what we do observe is that there is a probability that between, around the European summer, so July and August, when funding needs for the government typically increase, there might be some volatility associated with that, and that can start to cause problems. Now, what we're not envisioning at this stage anything extremely dramatic and a complete blow up, but it could, the wheels could start rolling basically and cause a few hiccups in markets and in the economy.
And that's happened a few times, I think, from memory, where we get to that period where they're trying to sort of, refinance the debt and roll it along. That it's a topical headline that catches some eyes around the US's ability to maintain its debt. Like it's probably, and I think they may have altered their debt ceiling a few times to make it work.
Correct.
But those things happen, obviously it grows over time. So those figures have to get bigger. But it definitely spooks people. And I suppose that's the balance about being, really understanding the market deeply versus sort of getting a little bit of that sort of mainstream media feedback around it too.
Mm-hmm. Absolutely. And the one thing we haven't mentioned in the context of, the US and its deficit is the big, beautiful bill that the Trump administration is trying to pass through Congress, which is essentially, everything you've mentioned just now. At the same time, it is an increase in the deficit because it's a big spending bill. And part of that is actually cutting taxes, or actually not even cutting taxes, but maintaining tax cuts that have been temporarily put in place in the last Trump administration. And part of that bill is also raising the ceiling, the debt ceiling. So if they're successful in passing that, it would all at once allow them to actually increase the debt ceiling and therefore issue more bonds, and therefore actually start coming into some of the problems that we mentioned where the debt starts rising too high.
I think when these markets are moving around and we see the movement, obviously there's a reaction for some people to pull back, for some people to approach it and expose themselves further and try and take some opportunities. Those things are challenging when they're moving so quickly. And I thought, again, one of the things we were able to do through the portfolios was around the currency. And I think obviously making use of a little bit of an opportunity there to switch things up. Could you just explain a little bit around currency? And I think hedging and unhedging is something that people don't really understand very well. So maybe a little bit of education and then explaining what we were able to do there.
Okay, so I'll try my best and probably fail, but I can try. Essentially, when as Australian investors, when we're buying US equities, to just pick that example, there's two risks that we're buying. We're buying the shares, right? So let's call it either S&P 500 or Microsoft, right? We'll buy Microsoft. Microsoft is denominated in US dollars, and we are Australian dollar denominated. So the second risk that we're buying with that is the risk that the US dollar depreciates versus the Australian dollar, so that when we sell the Microsoft shares, even though it's gone up in price, because the Australian dollar is worth less, then actually we're getting less dollars in return, right? So now if you want to get rid of the second risk of the currency risk, you can hedge your exposure, right? In other words, like through foreign exchange transactions, you neutralize that risk completely, and so the only risk that you have is just that of the Microsoft share that you've bought, right? So that's anytime you buy an international investment, that is the case, that you have a decision to hedge or not hedge. Now, over the last few years and with the financial innovation, that decision has become very, very easy to implement either way. You can buy an S&P 500 ETF, which gives you exposure to the largest 500 company in the US for 0.03 or 0.004% per annum. It's practically free. And you can have that same investment in hedged format, which would be, I think, 0.1%. So just a tiny bit more expensive. So really, the implementation is not an issue. It's just a question of do you want the risk or do you not? Now, if I pose it that way, the logical answer is, well, why would I want that risk, right? So no, I want the hedged version. Now, and this is where things get a little bit complicated, is that the Australian dollar is by nature what is, and this is a technical term, a pro-cyclical currency. What that means in slightly more simple terms is that because our economy is quite open to the world and to global trade, and particularly with our natural resources that we are huge exporters of, as the world economy goes well, Australia does well as well. And the Australian currency does well because people have to buy iron ore and pay for them in Australian dollars, and therefore they have to buy more Australian dollars, and the Australian dollars goes up, right? So when economy and markets go well, the Australian dollar gets stronger relative to the US dollar. And obviously the opposite, when things don't go well, then the Australian dollar devalues versus the US dollar. So anytime you have market volatility, you will notice that the Australian dollar loses value versus the US dollar. Now, if you have US assets, right, that are unhedged, if the Australian dollar loses value, right, your US assets are now worth more in Australian dollars. So actually being unhedged acts as a bit of a buffer for when markets fall, equity markets fall. Now, the flip side of that is when equity markets rise, you typically will erode a little bit of that value of that rise. But we tend to prefer the profile of be a little bit more protected on the way down than and give that up on the way up, right? And hence why our kind of neutral setting is to be unhedged in international equities, and particularly with the US. Is it relatively clear so far?
The best explanation I've ever heard for it, and it's because it's a complex thing, and I think people don't fully grasp it in isolation. But then they also maybe don't take it into account through those market movements and those those global events, the impact it can have, and people get caught up around maybe like stock picking and trying to pick the eyes out of the market rather than looking at how they're investing into it. And we talk a lot about structure of investment and people's flows in and out of investments and in the right entity. Then there's also when you're going to purchase, is it hedged, unhedged, like getting right down to that detail, because like you said earlier, maybe you've had the actual assets appreciated in value, but if you didn't have your hedging or unhedging correct, then you maybe have actually made no money in AUD terms. So you need to get this full filter right down to the bottom correct. What was the I suppose that opportunity that was identified through that period?
Okay. So what happened during the Liberation Day and the few weeks that ensued is that, as we all know, markets fell, and therefore, as expected, the Australian dollar fell as well, and it got down to about 60 cents on the dollar. So one Australian dollar buys 0.6 US dollar. Now, it's very hard to say, is that enough? Is that not enough? Is that cheap or it's expensive? Who really knows, right? But there are some measures of like long-term valuation. Clients could look up something called the Big Mac Index, which is a fun way to do that, looking at the price of a Big Mac in every country and comparing it to see which currency is overvalued relative to another one. But more seriously, at that point, we decided, the US dollar has gotten stronger and stronger over the last few years. And we feel like that rubber band is quite stretched. And especially with that additional pull in that direction during the tariff volatility, we felt, we have an opportunity here to hedge a portion of our US dollar exposure so that if the Australian dollar strengthens from that point onwards, that would be to the benefit of investors. So I would say it's a little bit speculative, but the opportunity was that relationship we felt was particularly stretched, and so on the balance of probability, we thought it was the right thing to do. So we did that just with that US ETF, the S&P 500 ETF. And important to highlight that this is just a portion of our international equity exposure. We haven't hedged completely. We've hedged the bit that is specifically just the US. Now, the implementation of that itself was quite interesting, which is we made the decision to do it when the Aussie dollar was at 0.6. By the time we implemented it, which was only just a day later, the Australian dollar had already bounced back up to 0.62. But yet we went ahead with it. It's currently sitting at 0.65. So basically, the higher the Australian goes now, the better that ETF will do. So far, it has been the right decision, and more importantly, we think it continues to be the right positioning going forward for what is still like a relatively small portion of our exposure in global equities.
Perfect. And again, I suppose the key part there is that there's a lot of data behind those decisions. There's obviously experience and there's that professional judgment, but it's driven by data and history to make sure that call is correct. Probably further to that sort of, I suppose, again, risk mitigation side of things, and one that's been topical has been the exposure to gold. And I think that's continued to do pretty well, maybe not as well as it had been doing, but it had probably been setting records. So where does gold sort of fit in? I suppose just again, I know we've spoken about this before, but like I don't know, so the renaissance of gold is the right term for it, but like it has been a really strong period for gold, and everyone seems to be talking about it again. Just a quick comment on why that is.
Sure. Look, like in all of the things that we do, by far, gold is the less scientific one, right? It's the less data driven, because it really just is a mark of sentiment around markets and trust in governments, maybe to some extent. Now, we've had gold in the portfolio for quite some time. I think we initiated it at maybe like a 2 or 2.5% position, I think, in most portfolios. And in the context of the last few years, really the last 2 years or so, it has done extremely well for us, and has grown quite a lot. And at the time that we met last week, it was 3.25% of most portfolios, like 3.25%. Why has it done well? It's always easier to say that after the fact, with the benefit of hindsight. I think the rise in inflation that we went through, the increase of debt to GDP for most governments, the fact that there's quite a lot of geopolitical conflicts in the world as well. So you got another dynamic here, which is countries like Russia, but more importantly China and a few others, would like to rely less on US dollars as a reserve currency. And so with their kind of central bank reserves, they would rather buy gold than US dollar assets. And so that has also added, but all of it are part of the same kind of thematic of higher uncertainty globally. And we definitely don't think that uncertainty has peaked or has gone away. And so we continue to believe that an allocation to gold is warranted in the portfolios. Now, the main issue with gold is that it's probably the only asset in the portfolio that doesn't provide any income. There's no dividends, there's no coupon payments as you would have for a bond, or for a term deposit, right? So it kind of, there's an opportunity cost from an income perspective to having gold. So we're in a very good position now where, because the price of gold is rising, we can afford to take profits, a little bit of it, and kind of that substitutes the income that we'd normally have. So that's what we did just today, actually. We did a few changes that were essentially just a rebalancing of weights back to kind of our targeted exposure. So we brought back gold from 3.25 to 3. I know it sounds like a tiny little change, but look, this, like I mentioned to you one time, it's a bit to me like a portfolio hygiene. You do those things on a regular basis, and it adds a little bit of value over time, right? Because markets have been going so well in the last 2 months, and more broadly in the last few years, the weight of equities relative to bonds and cash, and particularly international equities, is gradually edging higher. And what we've done now is just take profits a little bit on that and reinvest that where just rebalancing other portfolios.
Again, that key thing is just removing that bit of emotion from it and just bank a bit of profit, move on. And it's literally like the tiny little slithers of profit that would just continue to accumulate and just be really, data driven and take the emotion out. I start to get nervous in these times because people start to get too buoyant about where we're at. Like it's, people think, oh, it must be great, the market's going up. But for me, I'm starting to feel uncomfortable because I'm thinking, oh, like that creation of too much buoyancy when there's so much going on, as you mentioned, through the gold price with all these geopolitical issues and just other underlying economic issues for many countries. There's a lot of risk in the market still. So on that risk reward scale, we've just got to continue to be really, really balanced with that. Talking about gold and thinking about gold, one of these, a share that keeps on coming up in conversations is the Commonwealth Bank, and it feels like people's little pot of gold. But and I suppose I think a lot of fund managers, investment specialists would probably be a bit dirty on the performance of Commonwealth Bank, to be honest, because it's probably defied the odds, I suppose, in terms of if you use data. And I suppose it's an important part of, you use all the data in the world, but there's sometimes things that will defy it also. And, the Commonwealth Bank has continued to go up and up and up. I think it's in the 180s again at the moment. Just, I suppose, some context for clients out there who do ask the question about it, and just, again, why is it at this level? What's the story?
Yeah. No, look, as you said, it has baffled investors, fundamental professional investors in Australia for quite some time, and it continues to do so. Look, Commonwealth Bank, generally speaking, Australian equities are doing relatively well. Within that, banks are doing probably a bit better, and within that, CBA is completely shooting the lights out. What that's created is, when you look at measures of valuation of CBA, so you're looking at a price to equity ratio or a price to book ratio, which is probably a better valuation measure for banks. And you just, even if it doesn't mean anything for people watching it, it is just a measure of how expensive Commonwealth Bank is. And when you look at that relative to Westpac, NAB, and ANZ, there's a big gap in terms of the valuation. And the valuation is much more important than the share price, because the share price can go up, but if earnings are going up at the same time, then the stock is not more expensive, really, right? But in this case, it's the share price going up way above earnings growth, or way above the size of their lending book, for example. And so there's no real justification for that. And even if you broaden the comparison points to other banks in the developed world, you'll be hard pressed to find a bank that is as expensive as CBA by a long mile. And so hence why it has baffled us and a lot of other investors. I can point to a few things that, why is it happening? We don't really know. It's a bit like, what's happening to the price of gold. It's like, only in hindsight can you try to find a theory, which may or may not be true. What we do hang our hat on is that valuations are a little bit like gravity, and that at some point in the future they will reassert themselves. And if something has gone up that much and is not backed by strong fundamentals or stronger fundamentals, then at some point that gap will have to close, one way or the other. So why is CBA going up so much? We can point to the rise of index and passive investing, which means that if CBA is a large price of the index and people buying, ETFs rather than active managers or individual shares, then naturally, automatically, you have kind of like 10% of any purchase going to CBA. That's called a price insensitive buyer. It's an automatic buy that doesn't look at where the price of CBA is, just that CBA is 10% of the index. You've had a lot of foreign investors, apparently, who are seeing Australia as a little bit attractive, potentially as a way to get some China exposure without actually investing in Chinese equities. And then when they look a little bit more closely within Australia, actually, I'd rather invest in a defensive bank because it seems to be more safe, right? And maybe they're less attuned to, to the specificities of our economy, and then they don't look as much and they treat it as kind of an Australia exposure without looking at the details. All of that are really, theories and suppositions. We don't really know why. And unfortunately, look, we don't have any exposure to CBA in the portfolio, and that has negatively impacted the portfolio in a relative term. We've had Westpac and ANZ, and those banks have done well as well, but not as well as CBA.
I think, again, it's not, we just acknowledge that, we review that process, and you look at it, and I don't have any sort of regrets around that. I know personally, as you do the numbers and you look at them, and even at a high level, I said to a client the other day, if you took the name off the front of that stock and you assessed it out of a pool of however many there are available, like you wouldn't touch it. Like it wouldn't appeal to you. Like the data is just not even. It's not to say it's a bad business. It's just at this point in time, it's just not a good time to be purchasing it. And then
that's right.
If it's not a good time to be purchasing it, it normally means it's a great time to be selling it. But then there's the emotional pull of, do you sell it, especially because it continues to rise. And I think it's one of those ones that I find investors are a little bit more emotional about. I think I might have mentioned to you, they actually connect to the story, and they have only really had positive returns out of it. So it makes it really hard for them to step away from. And we certainly appreciate that. It's just, again, it's one of those quirks of portfolios and managing expectations.
And I mean, that story with the banks is particularly ingrained in Australia with Australian investors. But it reminds me a bit, to a lesser degree, of conversation we've had with clients maybe 5 years ago with the CSL. And people who own CSL were like, it's always gone up, and it smashes every ceiling that you can think of, and it continues to grow until it didn't. And really, CSL's price has been kind of flat-ish for the last 5 years. It hasn't gone down. It's just been flat with a little bit of volatility for 5 years now. And so paradoxically, it's started to become quite cheap, actually. But I think something like that could happen with CBA. And I don't have the crystal ball. As you said, it is a strong business, and there's no doubt about it. It is not a bank that is just about to go belly up. And even in a scenario of a housing crisis in Australia, we expect the share price to fall. It's not going to go to zero, right? So. That's a small probability of a really bad scenario, and even in that scenario, the strength of CBA should come through. It's just that the upside from here, I don't see it. I don't see where it's coming from.
Yeah, and I think the weird thing with it, again, this will be our last point on this, but it's sort of, it could continue to do equally as well as it has been in terms of its actual underlying performance, and but its share price can go down even if that happens, and that's where this sort of the sentiment driving things means that when we're saying if someone's saying sell CBA or it's not a good time to buy it, it doesn't mean that they think that the business has any issues with it and that it won't continue to be a strong business. It just means that it's not the right time to be looking to purchase an asset with that valuation. Now, that's where markets are unusual beast, is that, in 2 years' time, Commonwealth Bank will probably be bigger than it is today, but its share price could be half of what it is today also. So, they're the things we have to keep reminding ourselves.
Absolutely. I'm really looking forward to talking again in a few weeks and commiserating again.
I'd say we'll raise our bat when it goes through 200.
Yeah, exactly. CBA's price has gone up another 20%.
I think that's been good. Thank you, JT. Obviously, as always, just sort of hitting on a few of those topical issues again, and again, good to have a bit of a stock story and work through that as an example. Plus the gold, the hedging v unhedged, and always our US commentary. So I think maybe the takeaway is to look up the Big Mac index, and people can have a bit of a look at that and get some idea on how that functions. Thanks as always, and I know that the next quarter will come around quickly.
Looking forward to it. Thanks, Ben.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening. Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.